If you're like most successful people who worked hard all your life to accumulate a sizable portfolio, you're probably facing a big dilemma. How do you continue to grow it in a safest manner possible? Well, if you asked me that question 20 years ago, a simple 50-50 allocation between stocks and bonds would have been the answer. Today, the reality is that bond yields are at historically low levels. If a 10-year US government bond was paying 15% per year at the beginning of the 80s or 7.5% in the 90s, this year it pays just above 0.5%. So how do you protect your money and make sure it continues working for you and your family just as hard as you did? Hi, my name is Koby Lerner and I'm part of one of the top wealth management teams in the country. We focus on helping our clients build wealth in the most tax efficient way. So if that's something that you have interest in, make sure to subscribe so you don't miss any of my future videos. In today's video, I'll show you why high and ultra high net worth individuals are following in the footsteps of pension funds in search of low volatility returns. So let's jump right in. As populations around the world age, the need for income and yield have not. Traditionally, a 50-50 equity bond portfolios were capable of meeting the needs of investors, both big and small. Bonds were yielding mid-high single digits and made more than enough return for pension funds and high net worth clients to get the return they needed. As interest rates have dropped, it has become harder and harder to get adequate returns without taking on too much additional volatility. Due to the low interest rate environment, smart money had to find other ways of generating income and minimizing volatility. As pensions and institutional money have changed the way they invest, high net worth families do so as well. For the past few decades, pensions and institutional money have been increasing their allocation to alternatives. Now take the CPP for example. If in the late 90s it was 100% in government bonds, now it has 24% in real assets and growing. So why this trend, you're asking? When alternatives are talked about, they are referred to as private equity, private real estate, hedge funds, and private debt. And in today's video, I'll be focusing on private real estate. Now, endowments, pension funds, and high net worth family private office money have a good allocation to private real estate. Pension funds allocate anywhere between 20 to 30% in private real estate. Now, why, you might ask? Well, first of all, private real estate is the highest quality real estate in the world, and it is 90% of the real estate market. It is brick and mortar, a direct ownership in the buildings. Secondly, because private real estate provides steady returns in good and bad markets. Since private real estate is not publicly traded on an exchange, you don't have that panic selling. Institutions are more patient than the retail investor, and all the properties in the private real estate are core and core plus, meaning high quality buildings. Think of the first Canadian place in Toronto as an example. If there was a recession and the value of the building was to drop 5 to 10%, pension fund will be flocking to buy it because of its core location, long-term leases, and high-quality tenants. One such private investment that our team has been extensively using for our clients is the UBS Global Real Estate Fund. It has a core and core plus properties around the world, from multifamily in downtown Toronto, logistics in Tokyo, medical offices in Chicago, and the list goes on and on. During the violent sell-off in March, we saw some publicly traded real estates or REITs lose up to 70% of their value. Investors got nervous and started panic selling the publicly traded REITs. The UPS fund is down only 39 basis points year to date, less than 0.5%. The fund has historically low volatility of less than 2%, meaning that if the target return for this fund is 7%, you can expect with 90% confidence that your returns will fall between 5 and 9%. We also like the fact that the fund has a leverage of only 23%. In other words, you hold a portfolio of properties with very low mortgages. This is simply a cash generating investment with the returns coming from the rent collected and the appreciation in value. And finally, getting back to the asset allocation, this fund really helps in protecting a portfolio in market downturns since it has a low or negative correlation with the stocks and bond markets. For example, in the 2018, when the TSX returned minus 11%, if an investor would have had a 20% weighing in the UPS private real estate fund in a traditional asset allocation model, they would have been up 4%. And keep in mind that the only free lunch you can get in this business is diversification. This is truly a global with only 4% weighing in Canada. Not to put Canada down, but we are really a small dot on the map in terms of global real estate, and this fund gives you access to premium global properties. That's it for today's video. I hope you found it valuable, and if you haven't done that already, make sure to hit the like button. And if you want to see more videos just like this one, don't forget to subscribe to my channel so you don't miss out on anything important. If you have any questions or you want more information, leave a comment below. Thank you very much for watching, and I'll see you next time.